CEO of BlackRock, Larry Fink, recently released his annual letter.
BlackRock CEO Larry Fink is planning on opening up private markets to millions of everyday investors.
Here are the main takeaways. BlackRock is the world's largest asset manager with $11.6 trillion in assets. The letter begins with a brief overview of the history of the capital markets and a truly staggering stat that the last 40 years, more wealth has been generated than the previous 2,000 years combined. Now, unfortunately, if you haven't been invested in the stock market, you haven't had the same experience in generating wealth. But this brings us to a core issue we're trying to solve here. How do we get more people invested in the stock market and give them the ability to participate in the upside? There are two ways BlackRock is trying to do this. Helping current investors access parts of the market that they've previously been restricted from, enabling more people to become investors in the first place. The solution is not to abandon markets, it's to expand them. More investors, that's the answer. When people can invest better, they live better. Larry explains historically how financing has come from traditional sources, such as banks, corporations, and governments, but not the capital markets. Why? People traditionally park their money in bank accounts and money market funds. This drives corporate growth through consumption and funds physical spending through taxation. But capital markets will become a co-equal source of capital, and the logic is simple. Markets deliver better returns. Therefore, better returns attract more investors. More investors deepen the market. Deeper markets means more capital markets will help solve a key issue, the growing mismatch between demand for investment and capital available from traditional sources. For example, there's still $25 trillion parked in bank accounts or money markets alone. But by the year 2040, new physical infrastructure alone will have an estimated $68 trillion needed for investment. Therefore, capital markets will need to bring in more investors to be able to meet the demands we need to continue to move the world forward. But there is another issue. This massive investment opportunity is typically closed off for accredited investors, therefore locking out the everyday investor. BlackRock sees this changing along with the modern portfolio theory as we know it. A typical portfolio is constructed of 60% stocks, 40% bonds. BlackRock sees this transitioning to 50% stocks, 30% bonds, and 20% private assets. How will public investors get the opportunity to participate in the private markets? BlackRock has a plan. BlackRock is known for their iShares ETFs. This helped transition the market from a passive mutual fund-based market to an active, lower fee-based ETF market. They now look to break this divide between private and public investment, the same way they did for active versus index. How are they doing this? With three major acquisitions in the private market. GIP, or Global Infrastructure Partners, was purchased to serve a pipeline connecting BlackRock clients directly to the $68 trillion investment opportunity in physical infrastructure. This includes data centers through partnerships with companies like NVIDIA. 2, HPS Investment Partners, a premier player in private credit. And the big one for bringing private markets to the everyday investor, Preqin, a leading data firm in the private market. What makes Preqin so important? They're going to help bring clarity to the private markets, allowing them to eventually be indexed and available to public investors. BlackRock's goal is that Preqin do for the private markets what Zillow did for housing. With clear and timely data, it becomes possible to index the private markets just like we index the S&P 500. But there are some key issues when trying to democratize the private markets. Liquidity of private assets and lockup periods are just two issues to consider when trying to democratize these markets. These markets are not as liquid or freely tradable as the public markets are. But secondary markets are getting larger and larger, potentially helping to fill that gap. Look no further than OpenAI. OpenAI has raised over $106 billion being able to stay private through the secondary market, all while locking off access to the everyday investor. Bottom line, I think investors of all sizes should have the ability to invest in the highest quality assets, whether private or public. This is going to be one key factor to trying to help close the wealth gap. Now, I couldn't be more excited about this new investing landscape and the opportunities ahead. But Larry then turns to some key issues we still have with our current investing landscape. First, the current state of retirement. More than half of Americans fear outliving their savings more than death itself. I'll state that again. More than half of Americans fear outliving their savings more than death itself. This is why getting everyone into the world of investing is so important. Not only will it create a sense of security so you can live better with a higher quality life and for longer, but owning a piece of the economy not only lets you benefit from financial growth, it gives you hope and a sense of connection and progress. Second, regulation. A high voltage power line takes 13 years just to be approved. In China, it takes a quarter of the time. Larry references Abundance, a new book by Ezra Klein and Derek Thompson, and they address these very issues. They give him an example that back in 1860, we built 1,800 miles of the Transcontinental Railroad in just 6 years. Today, it takes California 6 years just to realize that they have to push their high-speed rail efforts back a whole nother decade.
Got him!
California has failed to build even 500 miles of high-speed rail. In that same amount of time, China's built over 23,000 miles. The worst case of this is in energy infrastructure. Demand for electricity is surging due to AI, electric vehicle, and other innovations. Larry notes that we need energy pragmatism, and this is to start with the slow and broken permitting process. Another example of where we're falling behind China is in nuclear energy. In the past 55 years, the US has shut down more nuclear energy than they've built. At the same time, China's been at the forefront of nuclear energy with small modular reactors. These small modular reactors are cheaper to build, they're safer to run, and they can be built anywhere. China's current nuclear plants will supply half of the world's nuclear energy. Why is China so bullish on nuclear and decarbonization? They see this as a clear path to be a leader in industry. Another reason China is so focused here is because there's a direct relationship between energy and wealth. More energy means more wealth. Prosperity is generally defined as the ability to produce and consume more energy. But regulation isn't just holding back America, it's affecting the EU as well. If the EU reduced intra-EU trade regulation to the same degree that we have for the US states, it would add $1.3 trillion to their economy. Now, don't get me wrong, regulation is extremely important. We want clean air, clean water, and a clean and safe environment. We need to find the balance of keeping innovation in our economy moving forward while still protecting our current environment. The regulation that needs to go is the slow, bureaucratic nonsense that leaves something sitting on a desk for years without taking any action. Finally, Larry finishes with the topic of digital assets and tokenization. He starts with a key question. Could Bitcoin really take away the US dollar's reserve status? Having the US dollar as the world's reserve currency has been a bit of a cheat code for the US economy. It allows us to run up massive debts, which the US government has been abusing. In fact, we have grown our debt 3 times the rate of our GDP since 1989. Debt sits around 6 to 7% of GDP, where prominent figures in finance such as Ray Dalio, the founder of Bridgewater, the world's largest hedge fund, has repeatedly stated that anything above 3% is unsustainable and spells trouble for the US economy. Our interest payments alone are now higher than military spending. By the year 2030, our entire federal budget will be overtaken by mandatory government spending and debt service, creating a permanent deficit. In summary, no system human beings have ever devised has generated more wealth for more people than the capital markets. The action to take away here is to get in the game and be an investor.